The most commonly used approaches out of these three are income and market approach. So we can first start with the income approach. So we can go to the next slide. Next slide, please. Yes. So when we talk about income approach, so income approach is typically based on the premise that the value of an asset or business equals the present value of the future earnings that are available for distribution to the investors in that particular asset or business. So the entire premise of income approach in very simple language is based on the future cash flows which are expected out of an asset or a business. Talking about the first method specifically, that is the discounted cash flow method, which is the most common method in the income approach. Now, this discounted cash flow method, which is also called DCF method, this method involves estimating the cash flow stream, which is expected to be generated by the asset over an appropriate period, and then discounting it to the present value using an appropriate discount rate. So now when we say about estimating the cash flow stream, the most important concept is analyzing the historical statements and income, analyzing all the historical statements, which include your income statement and your balance sheets, to understand the nature of the company, its revenue growth, its EBITDA margins, just to have an understanding of the entire financial planning of the company. Because once we understand the reasonableness of the historicals of the company, we'll be able to project the forecast for the company. And DCF is nothing but estimating the projections for the next 5 to 7 years. So it is very critical for us to understand and analyze the historical income statement and balance sheets of the company to make an accurate predictions of the next 5 to 7 years forecast. So once we have the forecast for the next 5 to 7 years, which is called your projections of prospective financial information, once we have all of that, we try and make certain adjustments to arrive at free cash flows. And the ultimate thing is that we have to arrive at the present value, because we are trying to estimate the value of an asset or a business as of the current date. Now, when we say estimating the present value, we have to discount these cash flows, which we have estimated for the next 5 to 7 years, at an appropriate discount rate. Because discounting at the right rate is very important, because that reflects the entire time value of money, that reflects the entire riskiness of your forecast. And the appropriate discount rate selection captures the riskiness that is being reflected in your projections. So for example, if we have a business which is pretty new in the industry, it will have a very aggressive projections in the near future. It will have a higher revenue growth to start with in the next 5-7 years before it reaches a mature stage or a normalized stage. So such company would have a higher discount rate, because the riskiness in the projections of this company are really high. So to accommodate for that high risk in the projections, we have a higher discount rate, and vice versa. If our company is already at a normalized level or at a mature stage where it is already operating, its margins, its revenue growth are already at a normalized pace of growth, then we apply a lower discount rate. And when we talk about discount rate, there are several factors and items which go to the calculation so that we have an appropriate rate. So the most typical method that we use to calculate the discount rate is the CAPM, capital asset pricing method. In that, it is basically a buildup of various premiums that are added to the risk-free rate. So when we talk about the risk-free rate is the return that is available in the market on an investment which is free of default. So when we say free of default, that most typically forms your government securities. So basically, what is the yield that you're getting on your government securities? in whichever countries you're operating. For example, in India, what is the yield that you're getting on Indian government securities? In US, what is the return on the treasuries that the US government is offering? So that forms the base of our CAPM model. We add on the equity risk premium to it. Equity risk premium is added to the risk-free rate to reflect the additional risk of equity instruments, which is there in the market. And equity risk premium is always forward-looking. So when we say that, we are trying to incorporate all the risk that is being captured in the forecast of your company. Then another factor which goes into your CAPM buildup is your beta. Beta is basically a measure of the systematic risk. And it is determined by comparing the correlation between the return on the market. Now, when I say market, it can be your S&P 500, your Euro Next 100. If it is a European company, it's a US company. If it's an Indian company, we have Sensex, Nifty, all of that. So all of these indices, basically. So what beta does is, beta is trying to compare the correlation between the return on market and on the return on your individual stock. When I say stock, I mean the return on your individual company or asset. So that is what the beta is capturing. Another very important thing which goes in your CAPM is the specific riskiness of your company. So why I say this is because when we are valuing 10 companies, each company would have its own customized risk, because every company is growing in a different stage. Every company is growing at a different rate. And there are various risk factors which are very specific to each company. For example, in my company, for example, if I'm planning to launch a product next year, so definitely my revenue growth, my costs, all of that would go up in the initial years before I reach a normalized stage. So there has to be a premium or a discount which is captured in my discount rate, so that this riskiness is getting captured, which is specific to my company. So this component is called company specific risk premium, CSRP, which gets added to your cost of equity while calculating the discount rate. And this is, again, like I mentioned, this is subjective to your specific company, and it differs from each company. Then another very important metric here is the country risk premium. Now, because we are talking about global methodologies, it is very important to understand that each country has its different risk profiles. For example, if we compare India with US, so obviously India's risk profile is much higher. So if there is a company which is incorporated in India versus a company which is incorporated in US, so the risk factor of the company which is in India definitely goes up because of the country it is operating in. So we have to add an additional premium to take care of that riskiness. That is called country risk premium. Okay. Then another very important premium is size premium. Again, size premium, as the name itself says, smaller companies have a higher premium because of the riskiness. So any company which is, suppose there are two companies, one is operating at a $10 million level and the other company is operating at a $100 million level. So obviously the company which is at $10 million level would have a higher size premium, which is ultimately captured through a higher discount rate. And the second company, which is at $100 million, would have a lower premium because it is already reached that high stage. So the premium would be lower comparatively, which gets captured in your discount rate. So all of these factors form part of your cost of equity, which is this portion. This is your cost of equity. So in very simple terms, our WACC, which is our discount rate, weighted average cost of capital, is nothing but a combination of two key line items. One is cost of equity and the other is cost of debt. Now, all the premiums that I mentioned are nothing but the additions to cost of equity, the various premiums that are added to cost of equity to arrive at the appropriate discount rate. Similarly, the second component is the cost of debt. Now, when we talk about cost of debt, it is obtained from the market, first of all, and it is sensitive to the economic conditions and the company's ability to service debt. So basically, cost of debt is nothing but if we have peers in the market, we need to see what are the credit ratings of those companies, and accordingly, what is the yield of that particular credit rating. So, for example, if there are 5 peers and they all are operating at in the range of BB to BBB credit rating. So, based on that credit rating, what is the cost of debt? When I say cost of debt, I mean what is the yield that we are getting in the market for that specific credit rating. And that is adjusted for the tax rate of your subject company, of your business, of your asset, where your company is operating. So we have these two components which gets added to ultimately form WACC, which is your discount rate. So basically, in a nutshell, what we are trying to say here is DCF, in DCF, we project the financial cash flows, we project all these cash flows, and then we have to arrive at the present value of it. So for example, if your valuation date is today, 28th March 2025, and you are estimating cash flows for the next 5 years, so you would, because of the time value of money, we would have to calculate what is the value of these cash flows of the next 5-7 years cash flows as of today. So for that, we calculate the present value using WACC, which is your discount rate. So this is the overall first component of DCF. That is the free cash flows, present value of free cash flows. Second thing is the terminal value, which is the second component of your DCF method. Now, terminal value is that after the end of the 5-7 years, which we are saying is the discrete period, after the end, what will be the value? So we always assume that each and every company is a going concern business. When I say going concern business, what I mean is that the company will continue to operate in this industry till perpetuity. It will not, the company will not cease its operations at the end of 5 years. It's just that in the 5 years, the company will attain a normalized level. After 5 years, we are saying that the company will continue to operate at a normalized level till perpetuity. To calculate the value after 5 years, we estimate the terminal value. Okay, so this second component, terminal value, we again present value the terminal value by discounting the terminal value at the same discount rate at which we had discounted the free cash flows. So we use the same discount rate to calculate the terminal value, present value of terminal value. So the bottom line is that the valuation that we get from DCF is the sum of the present values of both the projected free cash flows over the projection period, in our case, the 5 to 7 year period, and the terminal value. These two main components help us estimate the ultimate value from the DCF method. So this was the first method, DCF, which if you go on to the next slide, please. Now, coming on to market approach. So before we move on to market approach, I would like to highlight that what are the instances when we use income approach, specifically DCF. So there are companies which have visibility in their next 5 to 7 year projections. That today, if my company is 3-year-old company, so we know that in the last 3 years or last 5 years, this has been my revenue pattern, this has been my profitability pattern, and hence going forward, I know that going forward, I can make this much revenue growth or this much profitability. But let's say there's a company which has just started this year in January 2025. So it's a fairly new company. There is no revenue. We don't know what the revenue will be at the end of this year or the next 3 to 5 years. Then we cannot use DCF method. So for the companies in which the management does not have any visibility in the future, we cannot use the DCF method, income method. That is where your market approach comes into the picture. Now, in very simple terms, what do we understand by market approach? Market approach is nothing, it's just a way of estimating a value indication of a business or an asset by comparing the subject business to similar businesses in the market that have been sold. So basically, it gives a more specific, more realistic value. Because in income method, what we are doing is we are, it's as good as your inputs. It's as good as your projections. So if your projections are correct, more accurate, if your discount rate is accurate, you'll get a more accurate picture. But when we talk about market approach, it's based on the actual transactions that have happened in the market, actual prices at which the companies or assets have been sold. So in this method, we broadly have two methods. First is comparable company method, and second is comparable transactions method. So first, let's start with the comparable company method. So in comparable company method, the first step is identifying comparable companies, identifying the peers within the same industry, and there are various other features that we consider. For example, the companies, the peers that you're identifying, they should be, they should meet the criteria of your subject company. For example, in terms of size, it cannot be the case that your company is $10 billion company, but the peers that you are identifying in the market are all $100 billion companies. So there has to be a size bracket that we'll capture only companies with 10 to 50 million dollars. So we have to take care of the size, geographic location. If your company is based out of India, we would probably just want to focus on companies which are incorporated in India or probably to expand more in Asia. But we will not move on to European or US companies because the valuation of those companies are entirely different in terms of comparability. So geographic location, market sizing, any other company specific factors. For example, the key products and services that your company is offering. You will have to select the company in the similar industry and similar service line and similar product line. So all of these basic features we have to keep in mind when we are identifying a right comparable set, because this is the most important part of the market approach. Once we have the list of peers, and typically we try to keep the peers in the range of 5 to 10 companies, not more than that. So once we have with us the list of comparable companies, we can just stick to the previous slide. Yeah, we can just stay here. So once we have a list of comparable companies with us, we analyze their financials. When I say financials, I mean, we understand what is their enterprise value, what is their revenue, what is their EBITDA. Okay, so once we have all those financial metrics of these companies, we evaluate multiples. So there can be various multiples depending on your company's data. So the typically globally broadly used multiples are enterprise by EBITDA and enterprise by revenue. So when we calculate these multiples, enterprise value is also called EV in short form. So when we calculate EV to EBITDA and EV to revenue multiples, what we do is we apply the financial metric of your subject company. So when I say this, I'll just annotate. So let's take EV by EBITDA. So once we have EV by EBITDA of the peers, of the comparable companies, we will multiply this by the EBITDA of your company, of your subject company. Because then what will happen is when you have taken the EV by EBITDA of the market and you multiply that by the EBITDA metric of your subject company, you will arrive at the enterprise value. That is the value, the overall valuation of your subject company. That is how the market approach comparable companies operate. once we have an understanding of the business and all of that, we calculate the multiples of it, and we multiply it with our relevant selected multiple. Now, one very important thing to note in market approach, specifically in comparable company analysis, is that we have to always take the normalized EBITDA. I'll elaborate on this. So, for example, there is a company which is loss making. So, for the last 3 years, its EBITDA is negative. Okay. So, if we were to look at the LTM EBITDA, it is negative. But if we are looking at forward metrics, this year's EBITDA, 2025, 2026, 2027, going forward, the expectation is that the company will turn profitable at the end of this year. Then in this case, and this is very important, so please note, we cannot take prior year's EBITDA multiple. Why not? Because the company is clearly not operating at a normalized level. The company was loss making till the last year, and it is expected to turn profitable. So it is in a very growing phase. So we always have to take multiples which reflect the normalized stage of the company. Same for your revenue. If the revenue of your company is, let's say, revenue growth of your company is 50%, whereas the median or average revenue growth in that industry is 10 to 15%, then we cannot take that LTM of historical revenue number because your company is clearly not growing at normalized level. So please make a note of this point because this is very important that we always have to take normalized financials, normalized EBITDA, normalized revenue, whatever multiple, whatever metric you are using, it has to be at a normalized level. Okay. Yes, so this is this. Then moving on to next slide, which is the comparable transactions analysis. Pooja, can you move on to the next slide, please? Yes. So now talking about the second method in the market approach, comparable transactions analysis. So again, this is also based on the transactions which have had already occurred in the market historically. And we are trying to leverage those transactions which have happened in the market to understand the value of our company or our asset. So very similar to comparable companies, here also we first perform a screening of the relevant transactions. When I say screening, again, we have to identify the transactions which are very similar to your subject company. In the sense, in terms of timeline, we cannot go back and consider a transaction 10-year-old, right? So typically in industry, we stick to transactions of last 3 to 5 years. Okay. Then again, we have to take transactions with similar size, in similar geography, in similar industry, offering similar products, similar service line, all of those key features like we discussed in the case of companies. Same features we have to take care of when we are talking about the transactions. So your transactions also have to have the same similarity when it comes to the same industry. So once we have the list of 10, 20 transactions in picture, we see the multiples at which those transactions happen. So now what we are doing is we are identifying the comparable transactions. So once we have those comparable transactions, we apply the multiples that is derived from those comparable transactions to the relevant financial metric. How we do in the comparable company. When we say financial metric, it is this very similar. It can be your revenue metric, it can be your EBITDA metric, it can be your EBIT metric to finally estimate the enterprise value of your subject company. Okay, so both the main difference between comparable companies and comparable transactions is this only, that comparable companies, we are analyzing the multiples of the companies in the market. In comparable transactions, we are analyzing the multiples of the transactions that have taken place in the market for accurate comparisons. So this is the main feature of this. Moving on to next slide, yeah. I'm just thinking that if I should highlight any more point in the income approach and market approach before we move on to the cost approach. Just give me a moment. Okay. One more thing I would like to talk about is, so till now, I only talked about the enterprise value. What if you have to estimate the equity value of your company? Then in those cases, what we do is we make certain adjustments to the enterprise value to estimate the equity value. And what are those adjustments? In enterprise value, we have to deduct any kind of debt that the company has. We have to add back all the cash because it's equity value. And your enterprise value is nothing but equity value plus your debt. So you have to deduct debt component to just arrive at the equity value. And you have to add back any cash or cash equivalents or marketable securities. And we also have to add back any non-operating assets and deduct any non-operating liabilities to estimate the equity value. Okay, that is it. Then moving on to the asset approach or the cost approach. Pooja, we can go to the next slide, please. Okay, so the cost approach is based on a very different premise. Cost approach is based on the principle of substitution, that we are saying what a prudent buyer will pay. So any prudent buyer will pay no more for a business than the cost to assemble that similar business. Basically, what is the cost to replace that business or reproduce that business in the market? That is what the entire cost approach is based on. So as it is mentioned, that it is, we estimate the amount required to replace an asset with a new one of a similar utility, reflecting the current market conditions and technological advancements. Because with time, suppose there was a asset which was built 5 years back, with time, the market conditions, technological advancements, all of that change. So we have to keep all those things in mind when we are estimating any value from the cost approach. Okay, so again, this cost approach is always based on the going concern premise that the enterprise is expected to continue to operate into the future. Okay. And typically, if we talk about the valuation of businesses, asset approach is least commonly used method and frequently not utilized when valuing a business. However, when we specifically talk about land and all, we use cost approach more commonly. So in cost approach, in cost method, we have the most commonly used method is the adjusted book value method. So adjusted book value methods, basically this provides an indication of your of the value of your business based on the individual revaluation of all the assets and liabilities of the business. So basically, this method entails a separate valuation of all your assets and liabilities which are there on the business's balance sheet. Okay. So again, first of all, we have to analyze the financial statements to understand, to gauge the subject company's financial analysis, its understanding and all of that. So once we have identified all the assets and liabilities which are to be revalued by looking at the financial data, We also try to identify certain off-balance sheet assets and liabilities. When I say off-balance sheet assets in general, we must understand that not all assets are reflected in your balance sheet. For example, a typical case is the intangible assets. Although intangible assets form a part of your balance sheet, but intangible assets like your, other than your goodwill, there are various intangible assets which would be your customer relationships, your trade names, trademarks that you have. So we need to understand all of those as well. The leasehold improvements can be there, capital leases can be there, so all of that.